Hello and welcome to the show. I'm Paul Rickard, filling in for Peter Switzer. On tonight's program, we start with Marcus Bogdan, the Chief Investment Officer with Blackmore Capital. Reporting season is almost at an end, and Marcus shares his thoughts on the companies and sectors that have done really well. Some really interesting insights into a couple of telcos that you don't want to miss. Nicola Powell is the head of research at Domain, and her company's done some really interesting research into the history of property prices and really some surprising conclusions that downturns tend to be pretty short and sharp. And from that, she's largely concluded that this current downturn we're in is unlikely to take us back to pre-pandemic levels. So some insights that, at least in her view, that the market, the medium-term outlook for the market is actually a lot more healthy than a lot of the commentators are suggesting it's going to be. And finally, Simon Pressley from Propertytology, he looks at some of the growth factors that are driving the property market and names the suburbs and towns that he thinks could do really well. So stick around for the show for tonight. Let's kick off with Marcus Bogdan from Blackmore Capital. Well, we're coming to the end of reporting season, and there's been some interesting results have come out. Joining me now to get a sense of what we've learned in reporting season and some of the stocks he's really liked is Marcus Bogdan. He's the Chief Investment Officer at Blackmore Capital. Marcus, welcome to the program.
Good to see you, Paul.
Let's start by just getting your sense overall. I mean, I've seen some data earlier in the week that said things weren't going quite as well. I mean, what's your take on sort of, now that we're sort of 80% through reporting season, how it's gone?
Well, we've certainly seen moderation in earnings growth, and that was largely to be expected. So sales revenue has held up very well, but you are starting to see some pressures there on margin, and that's slowed EPS and DPS growth across this reporting season. But nothing really unusual, and I think within expectations that we were going to see earnings growth. It was certainly going to be slower than the previous corresponding period, but net growth both in earnings and dividends.
And what about outlook statements? So I was expecting many CEOs to be pretty cautious about what they say going forward, given the environment with inflation and costs and just in general, there's not a lot of upside in being too aggressive in terms of looking ahead. But they don't seem to be, my take at least, I'm interested in your take, is they don't seem to have been quite as conservative as I expected. Is that a sort of an assessment that you would agree with? And I think that's really important for thinking about how our market moves ahead.
Sure. Well, I think it's testament that the underlying economy is still sound. We've got full employment and domestic demand continues to be strong. And so I think that has been more supportive of those statements going forward. And it's interesting to see how they're tackling obviously higher costs. And that cost composition is changing. We are seeing, slight improvements in supply chains. And then things like staff absenteeism is starting to slowly improve as well. So, look, there are some ongoing negatives on cost, but there's also signs of some sort of moderation. And then when we've spoken to some of the consumer staple companies, they are actually quite positive coming into the Christmas period, which is obviously a critical period for their sales.
So both COL's reported yesterday and Woolworths reported this morning, and you probably haven't had a chance to catch up with those executives, but they were perhaps a little bit on the disappointing side was my take, but and that's how the market treated the result. But any comments from you, particularly about the Woolworths result this morning?
Yeah, and I think there's a third company that also reported, which disappointed the market, and that was Endeavour Group, which was the spin out of Woolworths of Dan Murphy, BWS, and the hotels business. And look, it has been an incredibly demanding period for big retailers, and to be able to deliver their services and their products in the last six months. They're facing chronic staff shortages. There's inflationary pressures there, disruptions in supply chains, and that was reflected in their results, and you could see the cost pressures there. The cost of doing business was up. But I do think, particularly on Endeavour and Woolworths, there are some more encouraging signs of sort of more normalised trading patterns, and you could expect that there could be some improvement in margins on both of those businesses. I think the Coles result was that they're growing below market, and that was certainly evident in a much stronger sales result from Woolworths today. But I would look at the price compression that we're seeing in some of those stocks as more of an opportunity rather than being overly cautious.
Yeah, they both seem to suggest a lot of the COVID-related costs were going to sort of, I won't say disappear, but ease. Those pressures would ease in the as we go into FY23. Let's go to a couple of the defensive industrials that you like. Two that I think you feel reported strongly. Let's start with Amcor.
Well, Amcor has done remarkably well throughout the pandemic, and it's one of the few stocks that has actually had positive jaws, in the sense that earnings have been able to grow at a faster rate than revenue. And they've been they're lucky in the sense that they are facing into Northern Hemisphere consumer staple markets. They've tilted their portfolio to more higher end packaging, and they've executed incredibly well. And they are one of the few stocks that have upgraded their guidance throughout the last 18 months or so. And they indicated, again, good revenue and earnings growth expected for 2023.
And what about Brambles? It used to be, I guess, part of many people's portfolios, fell out of favour, but it seems like the markets thought its report was very strong.
It was a stronger result, and they were at the time of their investor day in September 2021. They were suggesting only of profit growth of about 1%. But they've been able to, again, like Amcor, through contractual pass-throughs and surcharges, to deliver a much better earnings growth profile of sort of mid to high single digits across their key markets of both the US and Europe. And again, it's another company, I think, that's it's a global leader in pallets that has executed particularly well over the last 9 to 12 months.
Let's go to a defensive stock locally, Medibank, I should say. It really in the financial sector, but very defensive. I mean, it continues to move forward, doesn't it?
It does. And look, Medibank has seen good market shares, and they've seen good underlying growth at an industry level. And that's probably not surprising, as people are far more aware of health outcomes. You can see the congestion and the problems in the public system, particularly on waiting lists. And so the private sector as an alternative looks particularly attractive. But Medibank are in a strong position. They are getting revenue growth. They are gaining market share. And for the moment, the industry's growing. And so Medibank's in the portfolio, which will show modest growth, but an attractive dividend yield of around 4%, fully franked.
And when you talk about market share, I don't think we should underestimate how hard that is when you're the market leader. There's 40 odd health insurers in Australia. You've got 27, 28% market share. It is really hard to grow it, right? When you're the market leader, and I think that's a huge achievement for that company. And then
Absolutely.
And I know you like some of in the telco sector, which is a couple of companies there that you think have done well.
Mhm. Well, I think telcos have been the standout for me in this reporting season, and that's primarily Telstra and Spark New Zealand, which was the previous incumbent in the New Zealand market. And both companies have increased their dividend for the first time in 6 or 7 years, and I think that's a reflection that the underlying operations of those businesses have improved. They're benefiting from very strong markets, particularly in mobiles, and the industries are acting rationally, and they're being able to pass on price increases at the rate of inflation. So attractive dividends, which are starting to grow for the first time. And the other element which I like about those two particular telcos is that their ability to monetize their infrastructure assets. And both of those companies have sold down their mobile towers businesses for very, very attractive prices. And those proceeds have allowed them to invest back into growth, reduce debt, and increase dividends. And each of those businesses, like Medibank, these are slow growing businesses, but I think the momentum for both of those companies is encouraging.
And Telstra still holds, I think, 51% of the business. I think it calls Amplitel. So potentially that could be divested for, might be very keenly sought after by some super funds at some stage. Is that the thinking there?
Yes, there is. There's still further scope for monetisation of infrastructure, and also, the classical ducts and the copper, which is also going through, which needs legislative approval, but that scheme of arrangement has been issued now.
And finally, a company that you spoke about a few months back, Integral Diagnostics, that hasn't gone so well. So what are your thoughts on that company?
So Integral Diagnostics is the 4th largest radiology company in Australia. And some parts of healthcare have been absolutely affected by the pandemic, in the sense that there's been a huge curtailment in elective surgery and also general screening at a GP level. And Integral Diagnostics, it's seen quite a significant downturn in their underlying business. But when you look at radiology and diagnostic volumes over a 10 and 15-year period, the industry tends to grow at sort of mid-single digit levels. The most recent report for the industry showed contractions of around 4%. So I do think it is an essential industry. That screening is absolutely fundamental, and you are going to see a return to elective surgery, and so that those revenue and earnings growth rates will go back to more normalised levels, and hence why we still hold it in the portfolio.
And is there opportunities or likely to be more consolidation in that market, or is that part of the attraction as well from you as an investor for you?
Yes, so it is in two parts. For the companies that we want to invest in, we're always emphasise good organic growth, and I think that will recover. But there continues to be industry consolidation, and Integral have been a key part of their growth strategy has been acquiring smaller radiology groups, and I think that will continue. And so you'll see both growth, the normalised organic growth, coupled with acquisition growth as well, which should lead to earnings growth in the high single digits going forward.
Well, Marcus, some very interesting insights about reporting season, particularly the comment around Telstra and Spark Infrastructure being amongst the highlights. So, look, thanks for joining us on Switzer. That was Marcus Bogdan, the Chief Investment Officer at Blackmore Capital. Well, some of the data out of the weekend suggested that there might have been a bit of an upswing in the property market with higher auction clearance rates. But also there's some new research from Domain that says that downswings in the property market are typically pretty short, and maybe we won't the prices won't go back to pre-pandemic levels. Joining me now to discuss that is Nicola Powell. She's the Head of Research and Chief Economist with Domain. Nicola, welcome to the program.
Thank you for having me.
So you put out this research about upswings and downswings in the property market. Do you want to just take us through your chief conclusions of that research?
So what we did is we looked at the past 30 years of upswings and downturns across Australia's combined capital cities. Because we seem to have this kind of view that Australian house prices go through these wild boom and bust phases. But actually what this research showed is we go through periods of gains and quite often surging house prices across our combined capital cities. And then it's followed by a period of slight decline and sometimes even flatlined prices. So, in some of our cities, such as Adelaide and Canberra, as an example, there's been periods of time where they haven't actually gone backwards, they've just gone sideways. And what we found is if you average out the length and the percentage of an upswing versus the downturn, what we found is an upswing is always tends to be longer and also sees a greater percentage gain respective to the downturn that then follows.
I don't think those two statements would have been used to any property investor. That's why property prices are so much higher today than they were 10 years ago or 20 years ago, right? Because that's what markets do. So, I guess it's interesting that there's a lot of media sort of hype around property, and as you say, it does tend to be a fairly, at least on average, a fairly stable asset. So.
Look, when you have a look at those upswings, across the combined capitals, house prices on average during an upswing have increased by 33%. The downturn, as a comparison, is negative 3%. Right. So we see these surges in price. And I think, what this really proves and feeds into is that we need to step back and actually look as property as that asset that is a longer term investment. Because what the research feeds into, it's not timing the market that is important. And it's really hard to pick a peak and pick a trough. But it's actually the time spent in the market that really counts. And I think when you take a step back, timing becomes much less important. And really, when you're making your property decisions, you need to make those decisions at a time when it's right for yourself.
Yeah, I think anyone who's bought property and held on to it for the long term knows that they never knew where they were buying at the bottom of the market or the top of the market, but 10, 20, 40 years later, who cares, right? It's gone up so much. So, look, I think we also talk about that in the share market, right? Time in the market rather than timing. No one picks bottoms and no one picks the tops, right? So, but why do you think we get so excited about it all? What drives all the media hype around, that wants to tell us the property market's collapsing or prices are surging? I mean, it's not the data clearly doesn't show that, does it?
It doesn't. I mean, we do see property prices pull back. During the last 30 years, there's been 4 periods of time across our combined capital cities where we've seen house prices on that annual basis go backwards. 4 years in the periods of time over the last 30 years. I think, as a nation, I find this really interesting. I'm from the UK originally, and we just don't have this obsession with real estate. I've lived in Australia for more than a decade, and, we are just so obsessed with property. I think we see it as a vehicle to build our financial wealth and intergenerational wealth. I think, what we've seen during the pandemic in terms of such an acceleration of house prices is that it has created that intergenerational wealth for families. And, in some areas, when you look towards the Mornington Peninsula, they've seen extraordinary rates of price growth since the pandemic began. And it's like a lottery win to some families. And I think, we're so invested. There's more of us in Australia that actually owns a property. There are, a number of us who own, investment properties as well. We see it as a way to build that generational wealth, build our own wealth pool, and, fund retirements as well.
Yeah. Okay. Let's go back a little bit closer to home. Let's talk about the market at the moment. So, enough theory. Let's talk about practice. So, what are we seeing out there at the moment? I mean, some of the regional areas are still reasonably hot. So just sort of put in context your view about those areas where there seems to be a lot of interest and the areas where it seems to be a bit tougher at the moment.
Yeah, for sure. And I think, the key rule of thumb here is that we have seen momentum loss within our housing market, generally speaking, across Australia. While there are still areas their prices are rising, they're not rising to the level that we were seeing, during the height of the boom. What we're seeing at the moment is a bit of a multi-speed capital city market. We're seeing greater weakness in our higher priced markets, such as Sydney and Melbourne. But when you pick out those areas and kind of drill down, the areas that are seeing the greater weakness are those more premium price points. So, areas like the eastern suburbs, northern beaches, inner west, North Sydney and Hornsby, those really kind of premium pockets of Sydney. The areas, it's really interesting when you kind of do that comparison of the areas that are seeing the weakest growth and sometimes negative versus the areas that are seeing the strongest rates of growth. All of those areas that are seeing the strongest rates of growth based on an SA4 slice of Australia geography, it's really still in those regional markets, Brisbane as well, Adelaide as well. These are still our stronger performers across Australia.
Yeah, maybe they've got the better growth dynamics, question mark. So what are we, in terms of just looking at the capital cities though, I mean, the markets that have been hot, as I understand it, like Hobart, are still pretty warm, right? Or do you think that it sort of got a bit too expensive for itself and now the market sort of just caught up to, the growth was too strong there?
Look, areas like Hobart and some of those regional markets affect regional Tasmania as well, because I think it becomes an affordability issue, pushing people into regional Tasmania. And I think Australians are largely driven by lifestyle, and I think those lifestyle markets are, still performing pretty well. I think, we've got record prices in Hobart, and Hobart's been one of those cities that's continued to see record pricing for, a fairly substantial period of time now. But even Hobart is showing signs of slowing down in terms of its pace of growth. They still nudge slightly higher over the most recent quarter, but it's not to the level that we were seeing last year.
Right. What about sort of homes versus units? Because during the pandemic, or at least sort of in the months afterwards, people were talking about sort of the great sort of, people wanting to get larger homes, move out of the city, wanted more space. Everyone was going to be working from home. And sort of units went off the boil a little bit. And I guess also the lack of migration might have had an impact on that as well. Are we seeing any, how do you sort of see homes versus units sort of looking ahead for the next 12 months?
Yeah, look, I do think units are the one to watch, because what we saw over the most recent quarter is it was the first time, in almost 3 years that unit prices across our combined capital cities outperformed house prices. Right. So generally what we're seeing in terms of a pullback in price has been more substantial for house prices. And that's because during the pandemic, as you said, we saw this acceleration in house price growth as people wanted more space. They were able to work from home and they wanted to push further afield from where they worked. And what that created was this record price gap between houses and units across our capital cities. We've got that narrowing now. And I think, there is perceived value in units. We've also got an extremely tight rental market. It's a landlord's market across every single capital city. I think this is luring for those astute investors that are, out there looking for their next investment property. And I think particularly that perceived value where, even for owner occupiers, for first home buyers looking to get onto the market, the level of price growth that we've seen for houses, they have not been able to keep pace. And I think it's looking for that affordable alternative. And, unit prices do tick that box.
Now, looking ahead, we've got potentially the Reserve Bank increasing interest rates on Tuesday week. But we are into spring, or at least coming into spring, particularly in the warmer capitals. And that brings more activity and more action. And how do you sort of see the next sort of 3 to 6 months playing out in the market?
Look, it's been really interesting even watching clearance rates, how they've performed over that winter period. And, what we've got now in clearance rates is they seem to have stabilized a little bit. And, dare I say, even edging slightly higher. I mean, they're much weaker than what they were. And I think now that we're approaching spring as well, as you said, it's that heightened activity. We do see an increase in listings. I think for buyers, what they'll be able to approach spring this year is with time on their hands. I think they know that they've got choice on the market. I think they're not willing to overpay or compromise. So I think, what we've seen particularly from sellers as well is I think sellers are better at pricing to meet the market now as well. I think, it takes a while for that pricing adjustment to feed through. And I think, it's probably one of the things and reasons why we're seeing those clearance rates stabilize. But I mean, in short, what I think spring will be is opportunity really for buyers, because there is going to be an increase in supply. We've got overall supply on the market tracking higher. There is more choice. I think, we're seeing homes still sell pretty quickly, but they're not selling as quickly as they once were. And I think as long as you're a seller and you're coming to market with a realistic pricing to meet that buyer expectation, you'll get a timely sale. And, really in the grand scheme of things, we have seen a pullback in price, but that pullback really hasn't been much compared to what we saw during that upswing.
Now, just to put you on the spot to finish the interview, Nicola, if you were a keen investor right now, what state or city or region or house or unit what are the areas you'd be looking at right now?
So look, all of my picks have probably passed their boom, but I would be picking that lifestyle location. I think it depends upon if I wanted the capital growth or the cash flow. If I wanted something that was negatively geared, I'd absolutely be looking towards Sydney. Sydney's rental market has tightened, and I think with overseas migration returning, I think it is a competitive rental market, and it's probably only going to get more competitive. I think in terms of capital growth, I'd still be looking towards some of those more affordable, lower priced lifestyle markets. And dare I say it, even regional Tasmania can offer that. Okay,
well, we'll put you down for regional Tasmania, but is that the one you're looking at most, or is it, when you say more lifestyle markets, is that presumably around any of the major capitals, is that correct? Or?
Yeah, coastal area, hinterland location, anywhere, even when you look at the interaction between prices in the Byron LGA and Ballina LGA, Ballina was always deemed that kind of poor man's Byron, it was that more affordable. Seeing phenomenal rates of growth. It's areas like that you can see that kind of gentrification coming through, and you can see those other LGAs that have seen, we've got a median house price in Byron above that of Sydney. And, we've got other neighbouring areas rolling off of that back of that. So they're the types of areas I would look to. I would look to the, those kind of bridesmaid areas that haven't quite seen the level of growth of some of these more gentrified locations.
Okay, we'll mark you down for a bridesmaid area. I really like that phrase. That's Nicola Powell, the Chief of Research and Economics at Domain.
Well, joining me now is Simon Pressley from Propertyology, and he's got a really interesting topic to talk about. And despite the fact that he's looking more modern and groovy nowadays, the topic itself sounds so shockingly boring, but it's not, and we'll prove to you in a moment. Simon, what is this headline of yours about infrastructure? Infrastructure is like superannuation. People instantly fall asleep. But it is really important to property investors, isn't it?
Look, it is. It's often the undoing of some poor property investment decisions where people think, simply the construction of a hostel or a university is going to make a local market boom. It's never as simple as that. But this is arguably the most interesting research report that we've ever produced. If you're interested in economics, if you're interested in sport, if you're interested in real estate, any or all of those things, this report is jam-packed full of it. Sporting infrastructure, specifically stadiums and integrated entertainment facilities, is the focus of this topic, Peter. And we feel strongly that of all the different types of infrastructure, if you think of airports, seaports, hospitals, universities, train stations, you name it, an elite sporting stadium has the single biggest positive impact on a community of all those different infrastructure types.
Give us a standout example that proves the point.
Well, if you think of the regional city of Geelong, Australia's 10th largest city, Geelong is the hometown of the second oldest sporting team in this country and one of the most successful sporting teams, elite sporting teams in this country, in the Geelong AFL Cats. The role of sport, not just in Geelong, but using Geelong as an example, the role of sport, if you have a think about it. So according to official government statistics, 6.5 out of 10 Australians participate in sport. When your hometown has a team participating in a national competition, it gives all of that community something in common, a sense of purpose. And I'd argue that there's nothing more than sport that gets a bigger critical mass all interested in at the same time. What does sport do? Well, we spend hundreds of billions of dollars as a country every single year on health-related things. Sport gets people active. It gets people more conscious about their diet. It reduces expenses on health costs on obesity and heart disease and things like that. Important social issues. There's a lot of, particularly young people, who see sporting heroes as role models. And I would argue that a role model in sport, doing a post-game interview talking about the importance of not having drugs or domestic violence or those sort of things, that young person is going to listen to that athlete a lot more than they are some boring politician. Would you agree?
Most definitely.
And it encourages young people, especially some young people who might have had a troubled upbringing, might not be necessarily great academically, but they might be good in the backyard with the cricket bat or the football or the soccer ball or the basketball, and they see role models, identify with that, and that gives them a sense of purpose. So there's so many good things that come from sport. Specific to property markets, when governments and the private sector invest in elite sporting stadiums, particularly these days, when I say integrated, they're attaching to these stadiums, and it's not just the stadium itself, it's centre of excellence next door, it's entertainment precincts, hotels, restaurants surrounding it. Adelaide Oval and the new stadium in Perth are great examples of building large, world-class entertainment precincts. So there's tens of thousands of jobs in the construction of these facilities, but then it's all the hospitality-related businesses once it's completed. It's people travelling every second weekend from all over the country to go and watch their sporting team. Let's say you're a Parramatta follower in the NRL and your team is playing the North Queensland Cowboys. You might make a long weekend of it and go up to beautiful North Queensland in Townsville, especially this time of year when the weather is pristine. So many things come from elite level sporting stadium investments.
Yeah, and I guess the classic example from my neck of the woods is Homebush Stadium. Like you wouldn't have gone to Homebush unless you wanted to get assassinated as a young man. You know, it was a tough area. It was a home of abattoirs and stuff like that. Look at it now. There's a complete precinct, an entertainment precinct, the land values all around it, the escalation of apartments, all that sort of stuff. It's a really attractive area for young people and older people to live nowadays. And you're right, all the extra facilities even makes it more attractive.
Yeah, Homebush is a great example. Another one, our report's got maybe 4 or 5 case studies in there, but one we reference is at this stage, a proposal in Hobart. Now, the most popular sport in the state of Tasmania has always been AFL, but Tasmania is the only team that doesn't participate in the elite level national competition. And later this month, we'll find out whether Tasmania is successful in their pitch to be a participant in the national AFL team. Now, a big part of that is a commitment from the state government to develop a world-class elite stadium on, I would argue, the most pristine real estate in Australia. Constitutional dock that's famous for the Sydney to Hobart yacht race. There's a big parcel of land there right on the Derwent River that they're proposing, if they're successful with this AFL bid, of building an elite stadium there and also upgrading the existing stadium in Launceston, which already hosts half a dozen games a year for the Hawthorn AFL team, and it also hosts Big Bash cricket in the summer. So if that project, if that team bid was successful, there's going to be about $1 billion in infrastructure investment, mostly in Hobart, but a bit in Launceston as well. And already Tasmania has had 16 consecutive quarters, Peter, where it's been ranked number one in Australia in terms of the state economic performance. So things like this can do wonders for local economies on a long-term sustainable basis. And property markets, it's always been an economic story.
Yeah, and as I was just listening to you, I thought, you know, like the whole SCG Moore Park complex has been upgraded over the years, and all the suburbs around it, from the more expensive ones on the eastern suburbs right into Redfern, all those places, all their house prices have escalated. In Melbourne, around the MCG, Richmond was once upon a time a cheap suburb. Now it's a really high-priced suburb, and going all the way around to, I guess, Albert Park and all that sort of, it's all just escalated, and it's all been linked to infrastructure around sport and entertainment. Now, great story to go with a highly impressive looking Simon Pressley, who's clearly lifted his presentations you know, for the sake of business and success. Give us an area, you mentioned Tassie, but as you also know, Tassie house prices have gone through the roof over the last X number of years. Where do you think, where do you think a potential property investor who takes on board your lesson around infrastructure, where's a great suburb or town to think about investing in?
Well, I'll give you a few. Feeling generous today because you put me in good spirits, Peter. I mentioned Townsville already. You know, so that stadium was completed in 2020, just as COVID started. March 2020, that stadium opened, and it hosted State of Origin and NRL finals last year as well. But what the stadium is built around the stadium is what used to be industrial land, similar to your Homebush story. So that is going to unfold progressively over the next 10 years. Understated major regional centres such as Mildura. Now, Mildura is Australia's 43rd largest city, just completed stage one of an enormous sporting infrastructure project there. That's going to put it in good stead to host pre-season AFL games, Big Bash cricket in the summer. The visitor economy will do wonders from that. It's already a popular place for people to have, you know, long weekends, enjoy the Murray River and the local food and booze. So that's a good one. Orange in New South Wales, you know, is understated. Whereas Albury-Wodonga, arguably Australia's most successful basketballer, Lauren Jackson. Albury is her home city, and sport is an incredibly important industry for the Albury-Wodonga region. Really strong property market with a bullet.
Yeah, very impressive. Every time I drive through there going to Melbourne, you just get staggered at the magnitude of the growth. You know, the Harris Farm Markets complex, the Bunnings store. It's just huge. It's like you expect of a major city. In fact, they're even bigger than what I've seen in Sydney and Melbourne. It's quite extraordinary.
Yeah, one just came to mind. You know, many people have spent the last 2 weeks watching the Commonwealth Games. Well, in this time in 4 years, those Commonwealth Games will be held in regional Victoria. Those who like the track and field events, if you, like me, you know, stayed up late over the last fortnight watching those events, this time 4 years' time, on your device, you will be watching all those events being hosted in the beautiful regional Victorian city of Ballarat. Mars Stadium, that's already used to host elite level soccer and elite level AFL, will be redeveloped over the next couple of years, and that will be the main stadium for the 2026 Commonwealth Games.
Yeah, staggering. Simon Pressley, thanks for joining us, mate.
My pleasure, Peter. Have a great day, mate.
That's the show for tonight. If you want more great insights, go to switzerreport.com.au. And in today's edition, Tony Featherston asks, are car sales seek an REA buys? And if so, at what price? You'll see more at switzerreport.com.au. We'll be back next week. See you then.